This is FRM Part 1, Book 4, Valuation and Risk Models, and the chapter on calculating and applying value at risk. Now, from previous chapters, we know how to compute value at risk. The problem is the following. If we compute a value at risk for our portfolio, and let's just say it's 100, and we compute that based on kind of sensitivities to some of the inputs. Maybe it's a market index, maybe it's inflation, maybe it's an interest rate or an exchange rate. Whatever that variable is. So when that variable changes, then we know that our value at risk is going to be some number. What did I say, 100? Well, after that change occurs, then is the next change going to be that same 100, or is it going to be some different number? In other words, can we rely on our value at risk estimate and other risk measures as well? Can we rely on them to be stable over an entire range of changes in those relevant input variables? And the answer is, what would we like the answer to be? We would like the answer to be yes, and we compute that thing and we don't have to worry about it. But of course, the answer is no. So those are what the learning objectives are really trying to teach us about here. So we're going to look at linear and nonlinear derivatives. We're going to describe and calculate value at risk for linear derivatives, and then we're going to use this delta normal approach, which has its origination in option pricing. And then we're going to talk about some other things in there, including Monte Carlo and some correlation breakdown. And then, I mentioned this in just the previous chapter, a worst case scenario. This is how I live my life as a parent. What's the worst thing that can happen to my children? Of course, I'm blessed and lucky to have 4 amazing kids. So, all right, linear versus nonlinear derivatives. Here's the example that I give my students. Are you ready for this? Let's suppose that somehow you are able to stand 20 or 30 yards beyond the finish line of an Olympic 100-yard dash. And so these athletes, these men or women, are coming right to you. And if you look at them, they're running in a straight line. All right, so that's linear. And you could do some mathematics and do some calculus and take first derivatives and do comparative statics. And I guarantee you that you could pretty much, with almost 100% accuracy, compute this, where the next step is going to be. Right? The men and women, they do right step, left, right, left, right. So you know where they're going to step because they're coming in a straight line. But if you could do the same thing, and maybe you'd have to go maybe 100 yards from the finish line of a horse race, and you look down at these horses as they're coming down the stretch. These horses are wavering and they're going this way and that way. And so you could do some calculus, but there's no way you'd be able to compute where that next step is going to be because it's a nonlinear path. Now, I'm not sure if that has anything to do with humans have 2 legs and horses have 4 legs. But anyway, the visualization gives you a sense of linearity versus non-linearity. So a linear derivative is one whose value is directly related to the market price of the underlying variable. All right, so what that means is that when the underlying moves, the value of the derivative moves in a nearly identical margin. Of course, this can be seen with forward contracts and futures contracts. Remember, futures contracts are standardized forward contracts that are traded on exchanges or in the over-the-counter market, and they have daily settlement. A nonlinear derivative, however, is one whose value or the payoff changes. It changes over time, and of course, this is true with options. So for nonlinear derivatives, the delta is not constant. And here's the example. Suppose that we own a call option on a share of stock, and that share of stock is trading at $100, and the exercise price is $100, and the share of stock goes up to $101, right? The question then becomes, what happens to the price of the option? Well, it has everything to do with the delta of the option. If the delta of the option is, let's just say it's 0.5, that means that if the stock price goes up by $1, then the call option is going to go up by 50 cents. The delta of 0.5 translates into a 50 cent change in the price of that call option. Now, of course, once the stock price goes up to 100, then the delta of that option is going to change. Maybe it becomes 0.51, maybe it becomes 0.49 or some other number. But the important thing to understand is that nonlinearity means that delta is not constant. It keeps on changing with the change in the underlying asset. And this is one of the things that make options and the study of options and options pricing so cool. I mean, Black and Scholes and Merton, I mean, these guys did this work thousands of years ago. Of course, it wasn't thousands of years ago. Maybe it was 40 some years ago. But anyway, it seems like such a long time ago when they introduced us to the concept of option pricing and all the stuff that we'll talk about in a couple of chapters. But the advancements in understanding option pricing has really been dramatic. All right, so let's switch back over to kind of this theme that we've been talking about in the last chapter and this chapter, and we'll extend this as we go forward to this concept of value at risk for linear derivatives. And this is relatively straightforward. So look at that top equation up there. The value at risk for a linear derivative is just going to be the delta times the value at risk of that underlying factor. And I have two examples there. One with the S&P 500 futures contract. If we have a standard amount of 300, then the value at risk of that S&P 500 futures contract is just going to be the standard amount 300 times whatever the value at risk is of the index, right? So the value at risk of the derivative is a function of the standardization and the value at risk of the underlying asset, all right? And then the second example takes it from just a little bit of a different perspective. If a 1 point increase in a Nifty index increases the value of the futures contract by 100, then what is the value at risk of the Nifty futures contract? Well, that's just going to be the 100 times whatever the value at risk is of that Nifty index. All right, what about this concept of a delta normal value at risk calculation? So what we're going to try to do is approximate the delta for a nonlinear derivative. Now, this linear approximation is almost always used with the normality assumption. Remember, I said this to you in a previous video, that the founding fathers of finance, all those dudes back in the 50s and 60s and 70s, they pretty much were economists. And so, this normal assumption, normal distribution assumption was not really made because it was easier. It was just made because back in those days, that's kind of the way people thought that, over the long term, asset returns are probably normally distributed. All right, so to compute this value at risk, all we're going to do is take the delta. There's the little triangle there times the value at risk of the underlying factor. And so there's the great formula for the delta. And this applies exactly to what I was saying just a minute ago about that call option. So we take the percentage change in call value divided by the percentage change in stock price. So what did I say? That stock price went from 100 to 101, right? That was 1%, and then the percentage change in the call was just 50 cents or a half, right? And so this graph here at the bottom is a great illustration. I mean, it's really simple, but it's a great illustration of this non-linearity thing. Look, we've got stock price going one way, we've got option price going up, and when we compute that delta is going to give us the slope of the line. Remember, delta is a line there, that first derivative, so it's a line. It's going to give us the slope of the line right there where it intersects with the option price in the red. And so note that as we go like this and this and this and this, or this and this, I'm going to break my wrist there when I do that, but that delta is going to change. Now here's the issue, that let me go back here. If we use the delta approach, what's going to happen is that for very, very small changes in stock price, this is going to be fairly accurate. But once we get into stock prices that have lots of volatility, right? And remember that options are typically not written on utility companies because their stock price goes like this. They're written on companies like Apple and Google because their stock prices go like this. So for large stock price changes, that model doesn't really work as well. And so that's what this picture here is what I was doing with my wrist, the blue and then the green. And so look at the bottom arrow point. For large changes in a nonlinear derivative, we have to use what's known as full revaluation. So we have to use the delta and we have to use the gamma. And we'll talk at length about that in a future chapter. But here, let's go back up to those circle points. This is important. This is an easy thing to do, but it can be pretty inaccurate. And in addition, and this is really where we're trying to get to the heart of our financial risk management responsibilities, it's probably going to underestimate the occurrence of extreme losses. Think about it. If we say something like, oh, value at risk is going to be 10 million, and so everybody listens to us and say 10 million, and they're making all these decisions, right? That information is going to help our colleagues make decisions all around us. And if the value at risk is really 25 million, then we're way off. All right, so what we're going to do is we're going to fully reprice the portfolio under a set of scenarios. This is really popular, and it's because it gives us reliable estimates of what that value at risk ought to be. Remember, we can look at the past and say, all right, the most we've lost over the last 10 years is $10 on this particular asset. But that doesn't mean that that's the most we're going to lose going forward. We might lose 12, we might lose 20, or we might lose the full amount. Remember, with options, the worst thing that can happen is that you can lose all of your investment when the option expires out of the money. But that's kind of a separate issue. What we want to do is we want to figure out what's going to happen between now when we purchase this derivative or some other kind of an asset or a portfolio until it either expires or matures, or until we have a liquidity event in which we need to liquidate the portfolio. So what are the advantages there? Accounts for the extreme observations, and it of course is going to allow us to figure out where those horses are trying to run. All right. Now, of course, when you do this full revaluation, it's not like you can get out your calculator and hit the PV button and hit the FV button and solve for I. This can be particularly burdensome, and especially when you have these things like collateralized debt obligations or mortgage-backed securities or options on swap contracts or some exotic option in which you're trying to price, let's say, a weather-related derivative, in which you say something like, all right, look, let's agree to trade assuming that the average temperature is going to be 55 degrees in 6 months or whatever it is, and that temperature changes, and then you can revalue, et cetera, et cetera. So the computations can be quite burdensome. That's why, of course, we look at ourselves in the mirror and we say, you know what, my brain can only process so much. That's why we look at the computer and we say something like, I bet you can do better than I can. So we use this Monte Carlo simulation. And so we can rely on thousands, maybe tens of thousands. Oh my gosh, if we have a strong computer, maybe hundreds of thousands. I always think about those telescopes where they point it out there, and they can see, like 10 light years away or 100 light years away. I can't even wrap my mind around what a light year is. But anyway, if we can do that with the refraction or whatever it is that the scientists do, then surely we can program a computer to come up with tens of thousands of possible outcomes so that we can wrap our arms around what is the true value at risk. Now, what do we like about these things? It's going to successfully address multiple factors. And of course, when those numbers of simulations increase, then all of our estimates, our estimate is going to be here, maybe the true value is down here if we do 1. But as we increase that, we're going to have all these estimates, and so what's going to happen is that the deviations are going to decrease. Now, with lots of models, this is model dependent, that it's not going to be 100% accurate. But still, what it's going to allow ourselves to do is to, instead of trying to wrap our arms around the problem and having to stop here, we can go like this, and we can go, and maybe we can touch our fingers, even though we can't lock in and guarantee that estimate for value at risk as being 100% accurate. We can get to the point where we're, interlocking. I don't know. Depends on the model. Now, of course, the next step then is to figure out how we can use our model to stress test. And this is a term that really became popular after the 2008 financial crisis. And in fact, it has spilled over even into the popular press, stress testing the models. We need to figure out stress testing the models. And really, this is just a scenario under which we view and we observe and we try to figure out how these significant negative market events are going to affect things like the performance of our bond portfolio, our equity portfolio, our derivatives portfolio, or our alternative investments portfolio. I mean, any of these things that we're trying to manage, and we're trying to layer this with good risk management principles. And so what we do under stress testing is we say, all right, what are some possible events that have happened historically? And there I have in the circle point a couple of them over the last 29 years or so. We can say, all right, what are the chances of those things repeating themselves? And that's a good stress test. However, we can also try to predict what are going to be some future events that might occur. Remember now, we have this global economy, so we're linked with developed economies and developing economies and emerging markets. So all of these markets and all of these countries are doing the best that they can to try to grow, right? To become more and more attractive to world and global economies. But they're going to hit bumps along the way. So what we can say is something like, let's suppose that this specific country defaults on its massive loan portfolio. How is that going to affect our bond portfolio, et cetera, et cetera? And we can isolate them into one country, or we can extend them to kind of interconnected markets. But the important point here is that what we want to know is there contagion? Is there a spreading of the financial crisis, or is it going to remain localized? But the question that we're asking here is that, let's suppose that we have this future event that may or may not have occurred historically. Is it going to stay localized? But more importantly is, what happens if it spreads? Now, of course, the problem with this and the big weakness is that, the historical record, over the last 500 years is littered with financial crises. But, every one of those can go back and have various inputs and variables that contributed to that particular event. And so we've got to worry about the following question, are those events going to reoccur? And if they do reoccur, they're probably not going to reoccur in the same way that they did in the past. All right, so the historical simulation approach does not limit itself to specific events in the past. What happens, though, is that we use all past data to single out specific instances when those extreme losses were recorded. And it's pretty simple. The distributions can be almost anything, and the securities don't have to have that linear relationship. But of course, what we're doing here is we're limiting it to actual historical data. And so again, let me repeat that once we use historical data, that historical data is dependent on those particular macro and microeconomic variables that were relevant at that particular time period. So one of the challenges then is to find those events that occurred that have similar economic support to what we're experiencing today. Now, scenario analysis is just the exact opposite. What we're going to do is we don't have to rely on that past data. We're going to take a look at a set of predetermined scenarios. So it's not limited to historical events, but of course it has some weaknesses. It's probably going to be a combination of different risk sources. And of course, we're going to have to worry about correlations between and among all of these different things. Which means that when we consider all those correlations, we've got to look at total risk. I think this is the last learning objective in this chapter. This is my favorite thing here. Worst case scenario, focus on extreme losses at the tail, right? So what we have to assume is that some unfavorable or negative event is certain to occur, and then compute what that worst possible outcome is. And I think this adds tremendous value to our understanding of risk and risk management. If I were to come to you and say, hey, look, you have a portfolio of $100 million, maybe it's debt and equity and derivative and alternative investment securities. And let's just suppose that I'm really, really smart and I say, look, the worst thing that can happen over the next month is that the value of your portfolio is going to be $75 million or $65 million. This adds tremendous value to our understanding of risk. And I think that takes us all the way up to the end of this chapter.